Good afternoon, everybody, and another very warm welcome to the Institute of Financial Accountants National Branch meeting. My name is Jonathan Barber, Head of Business Development for the Institute and your host this afternoon. I, as always, will run through a small number of Institute slides before I welcome and introduce today's two guest speakers. I'm sure there aren't many of you joining us today who haven't attended an Institute webinar at some point in the last 14 months. But just as a reminder, or if this is your first webinar, some housekeeping. Please bear with us if we have any technical issues. We will look to resolve those as quickly and as efficiently as possible. I will though say one thing, do check your own setting and your own connectivity if you're having a sound or a visual issue. This, as always, is an interactive session. We're not face-to-face and we haven't been for 14 months, but please, you can use the Q&A facility or the chat facility to ask your questions, to make observations, to engage with me and today's two speakers. So please do engage, do ask questions, do get involved. For everybody's record, the webinar is being recorded and we will make it available via a link within 24 hours of today's session. So just some housekeeping points for everybody. As always, this isn't the only webinar, the only CPD that the Institute are putting on over the next month. Please take a look, visit the Institute website and specifically the CPD webinar section. Tomorrow we are running a webinar alongside funding options that is all about recovery and reform, looking at the post-COVID lending landscape. The charity financial reporting webinar has been rescheduled from next week to the week after, the 8th of June. There is a final national branch meeting on the 9th of June before we take a break in July and August. We return with a programme in the autumn. A couple of technology-led webinars to make you aware of. Why you need to look at more than MTD for your clients on the 9th of June, and how trends in cybersecurity will impact accountants. That's on the 23rd of June. We do also have in June a couple of further local branch surgeries, one taking place in Yorkshire and one in Scotland. The local branch surgeries will return again in September across the network and throughout the region. So please, if you're unclear as to what we're running, what's available, do look at the website and look at the CPD section. There was one particular webinar I just wanted to draw to people's attention, and that's actually a series that we're running next month in association with Shane Lucas, all about developing your practice. So for anybody, you might be 18 months into your practice journey, you might be 5 years, 10 years, 15 years, but you're wanting to take those steps to develop and take your practice to the next level. Please do register and sign up for that 3-part series, the 10th, the 17th, the 24th of June. Shane will look at, across the series, he'll look at mindset. He'll get you to think and challenge yourself as to where is your practice at the moment and where might you want it to go. He'll look at pricing. He'll look at how you go about gaining new clients and clients that you would want to gain, as well as looking at your existing client base and identifying options for how you might be able to generate additional income streams from those clients. And I think the series finishes off with, how do you find the time to do all of that? So developing your practice, a series on the 10th, 17th and 24th of June. I also just wanted to make members aware of various consultations that we would very much hope and ask that you get involved with at the moment. They're all to do with tax. We as an institute appreciate that tax is a hot topic. It remains an extremely relevant topic for our members. But the consultations on the screen, for us to provide feedback, for us to engage with them, we do need your support. We do need your views and opinions. For your institute to have a voice, it's vitally important that you tell us what you think about these things. Consultations, again, found on the website, underneath the tab About Us, and underneath the section Operating in the Public Arena, in Public Practice. Please do find the consultations. If you have the time, please do respond. Your opinions, your views are very welcome and they're valid. Just 3/4 other matters. This session is recorded. If you've missed a webinar that the Institute have held over the last 3 months, you can find those recordings on the Institute's YouTube channel. If you go into YouTube and if you search Institute FA, you will find the Institute's channel there. Content, articles, information, support. Please, if you don't regularly review or look at the Institute's digital platform, please take a look, www.financialaccountant.co.uk. And if you haven't followed us or aren't following us across the various social media platforms you use, Twitter, LinkedIn and Facebook, please do follow us. There's a lot of information posted on a daily, weekly basis that not only keeps you up to date, but I hope provides you with an insight into what we believe is happening within that small, medium-sized practitioners arena, as well as the SME business arena. One final request, you will see at the bottom of my screen that I'm using on my slide the Institute's logo. That is the Institute's logo. That is today's logo. That's the current logo. If you are using another logo, it's probably out of date. And I would strongly ask you change the logo to reflect the current logo that should be used. Again, you find the logo within the members area of the website. Log in, members area, logos. It gives you access to the logos, and it also gives you guidance on how to use. So please do have a check. If you're not using that logo, you probably need to take some action. So an update from me and enough from me. Can I warmly welcome our 2 guest speakers this afternoon, Paul Redmond and George Skelton. The session is split into 2 halves. Paul is going to talk first, and Paul will talk about the practitioner's journey from compliance to advisory. Linked to that, George is going to talk about access to the EU through an Irish company. And I think there's some technical informative detail that George will provide with everybody, and hopefully offer a few solutions given maybe the administrative burden that Brexit has brought at present. So by way of introduction, Paul Redmond is a qualified CPA. He's also a fellow member of the Institute of Financial Accountants. Paul possesses over 30 years experience. His focus or his efforts today are broad and varied, whether that's about improving businesses' performance and efficiencies, whether that's supporting with financial and management accounting tasks, a big business coach and mentor. Paul also specialises in digitising and automating accountancy practices. Paul is an articulate, experienced presenter, having talked to members of the Chambers of Ireland, the Law Society of Ireland. Paul is also a mentor with Wexford Local Enterprise. Paul started his own practice, RDA Accountants, back in 2002, and Paul's practice won Practice of the Year in 2020 with Xero. George Skelton is a chartered accountant and qualified tax consultant. George's career and experience has been developed, and I hope I get the order right, George, with PricewaterhouseCoopers, Grant Thornton in Ireland as a tax specialist, before returning to Wexford to take up a similar role with RD Accountants Limited. George specialises in a number of areas: succession planning, corporate and group restructuring, tax efficient cash extraction, and reviewing all elements of client businesses to ensure tax efficiency. George has also previously worked as a tutor for the Irish Taxation Institute and the Institute of Public Administration. Gents, it is a pleasure to welcome you both this afternoon, and thank you for taking the time to join us and to share some of your knowledge and experiences with us. Without further ado, I will stop sharing my slides, and Paul, I will hand over to you. But thank you both very much indeed.
Okay, so hello everybody, and Jonathan, thank you for that amazing introduction. Sometimes when you see the journey, you know, when somebody reads it back to you, you look at yourself and say, you know, I'm over 30 years at this game. I know when you look at me, you say it's not possible because I look a lot younger. And in Ireland here at the moment, the process for vaccination went on age. And unfortunately, or fortunately, I qualified last week at my age. George is quite a good bit behind me. So without further ado, I suppose really what I want to talk about today is something slightly different, and it's a massive passion for me. I am an accountant by profession and by heart. I've in this journey for years and years and years, and I just want to really talk about my own experience and my own practice on the journey, as I say, from compliance to advisory. So let me just start by saying something. First of all, I want to review I just want to get the slides there, sorry, slideshow, Zoom slideshow. So first of all, I want to review the accountancy model in 3 steps. And this might be somewhat controversial. It's not meant to be controversial, it's meant to be thought-provoking. And I know we have Shane Lucas coming on for a series of webinars, and I think this will lead quite nicely into what Shane is going to talk about, and it's going to talk about mindset. This is done from the perspective of me being a business owner and me being an accountant in practice and having fantastic partners, George being one of them, really. So when I looked at my practice a number of years ago, this was the old way of doing practice. We took on a client, we gathered all the details from the client, we kept the client compliant, we went through everything we could to get their books and records up to date. It was a manual process. We then filed all their tax returns, and all the client was looking at was to make sure that through that manual process, we'd answer any questions they had, but it was all reactive. The clients came to us with the questions and we answered the questions for the clients. And then we waited until the following year's return is due to interact with most of those clients. And in the meantime, we went around chasing and looking for new clients to add on every year. That way worked really well for us for a period of time. But what happened is, and we're only after recently coming through a tax deadline in the UK, and you know, tax deadlines for us in the past went through problem, crisis. It was getting information in, getting work done, moving through that work, getting the stuff done, late nights, long evenings, staff unhappy. Now, it was profitable. And in that time, we were making a lot of money at that time doing it the old way. But I'm going to say now, the old way of running an accountancy firm is well and truly dead, in my opinion. And as you can see there with a nice little headstone, that comes as a result of me being the son of an undertaker a number of years ago. If you don't believe me, this slide is a slide that came out in September 2020. How has the pandemic impacted the way accountants work? And this goes for bookkeepers, accountants, and professionals like ourselves. Within the space of 24 hours, as a result of 5 years' work that we have done to make our practice digital, within 24 hours, all our staff were sitting at home with a laptop, right? And which was fantastic. When you look back on it, it was a great way of doing it. But this whole obsession with Zoom, Teams, online meetings, that process had to be learned for ourselves and our client. So that process is now embedded in the way we work. And I believe going forward, it's going to be a hybrid version of this forever in the firm, because we've got rid of the idea of talking on Zoom and talking on Teams and interacting with our clients that way. So based on that hybrid model of the change process and the fear everybody had, including myself, of going through that digitization at that time, or going through the idea of learning how to help our clients really quickly when every business was closed down. We done it in the space of everybody else. We done it in the space of 3 or 4 weeks, in the space of a month. But even at that point in time, when we moved really quickly, and the fear went over when we done it a few times. And the reason I'm saying that is the idea of digitization, and a lot of people are talking about making tax digital in the UK, is huge now. These are just enablers to enable us to speak to our clients more. So the big question is, after you look at that, what else can you modernize within your practice? What other things can you do in your practice to actually modernize your practice going forward? So if a firm relies mostly on compliance work, we're currently being replaced by technology. When we were doing this years and years ago, and the same, there's a huge number of accountants on board here, and we all done the same thing. Someone has in books and records, we typed them up, we put them in, we answered, we reconciled everything. Now at the moment, you can set up a bank account on Zoom in the space of 15 minutes. Clients can have multiple bank accounts, they can have multiple, and it's all done technology behind. So for our compliance work and the rapid decrease in fees across the industry, we need to change the way we do it. Clients are demanding much more than just doing their books. That's the #1 reason practices are struggling today, and we were struggling. We were struggling because we were offering that 80% compliance work. We have changed that model substantially, and it's simple to change when you know how to do it and you have a blueprint for doing it. So as the accountancy, as the stress comes in, pressure comes down on fees, clients don't want to pay for stuff that's done in historical. We moved it to an advisory model. This is an important point. Compliance is a lot more complicated than it used to be. Like we've created another webinar that we talked about, which is the rise of cryptocurrency and Bitcoin and blockchain technologies. Like we have clients now that are interacting in this hugely. It's not about the investment. I'm not talking about the rise and fall of the market and the size of the market. I'm talking about the technology that brings on board, and how do we treat that from an accountancy profession, and how do we look at that, and what does it even mean for the profession? The other thing is, traditional accountancy, in my opinion, was all about being reactive. Clients needed to be proactive. And when we look at a client today, if you look at the analogy of a doctor and look at the analogy of a practice, you go into a doctor's practice and you get a medical done, they do a blood test. They know everything about you in the space of 15 minutes when they look at that blood test. They will tell you that you need to go to see this consultant, you need to go see an eye specialist, or you need to go see a heart specialist, depending on your circumstances. I looked at that analogy, and then I looked at my practice, and I said, in my practice, I need to do the same for my clients. I need to be the person that the client comes to. If I'm a client at the moment, I need to have a bookkeeper, an accountant, a tax advisor, a financial advisor, corporate finance. I need somebody to help me with coaching. I need to do this. And a client is looking at all these saying, I'm not even aware of this and I don't want to do this. And as a practice owner, I'm saying, well, I haven't time to get my tax returns done. Where am I going to find the time to do all this extra work, right? So it's that side of it, being proactive. But if you're a client and you know that you can pick up the phone and talk to me as your accountant and just do, I'm aware of the problem and I'll help you solve that problem. It's a different, absolute different line. The bottom line in all of this is, the traditionally old school is almost dead, and the rate of change is changing so rapidly in terms of artificial intelligence and in terms of the way you can upload bank accounts now to the system and digitization of taxes and all of that. So the demand for the change of services, don't get me wrong, I'm not I'm not saying that compliance work is gone. Compliance work, I love it. It's an opportunity. It's a huge opportunity for the practice owners, and it's a massive part of our business now and going forward. And I'll show you a little bit later on where that fits in. I suppose, why should you listen to me? Really, I think, and Jonathan has went through that and given us like I've over 35 years experience. Thanks, Jonathan, for dropping it to 30, because I know I look a lot younger than I actually am. We were lucky enough to win multiple awards in the practice. We got 0 practice of the year in 2020. We have expanded our practice across Ireland and into the UK. And for me, digital advisory to clients and a coach to accountants, that's the real area that I love working in. It's the area I've a real passion for, is helping practice owners, because there's so much help out there when you look at digitization for the clients. There's this app and there's an app stack, there's an app for this and there's a thing you can do for that. But there's no one, like I'm an accountant and I'm focusing in on this because I've done it as my practice and I've done it with a team. And winning awards is fantastic, and I'm not minimizing the impact of that. But the idea for us is it builds the team confidence, it helps the team grow, and it helps the clients make you aware. As I said, I've walked the path and I've won the awards. For me now, that's the old traditional style. What does the new style look like? So what's a 21st century practice currently looking like? We use one simple app to make compliance faster, easier, and more profitable. I can tell you within the practice today, there's 420 jobs open in all the practices. I know there's 7 stages of each of those jobs are at, and I know what the work in progress, and I know that's driven by one system and one app. And the real point about this is, I know you're saying, well, I'm so far away from that. How do I get to that point? This is the part where it's not difficult. It's 5 apps in total. But it's a mindset. And I know Shane is going to talk about mindset and consultation. It's where you see yourself in your practice. So we've now become the person that clients contact for all their major financial decisions. And contacting you for those major financial decisions means that we're the profit partner with the client. So we found massive ways of providing services, in-demand tax, financial services, because we're adding to our practice. So what we were experiencing was, as our clients grew previously, our practice wasn't growing. So what was happening was the clients were looking for an alternative solution. But every single practice owner that's on this panel today can offer whatever service the client needs by having correct partnership model in place. And that is critical, that is vital to looking at developing the practice going forward. And an institute like the IFA, they support the growth of practices, because for us to maintain that relationship long-term with the clients, we need to be offering more than just the compliance services. We call this becoming a digital advisor. In my opinion, it's the single biggest innovation to happen in the profession, and it's completely a new unique way of growing a firm's profitability. I can tell you now from my experience that looking at practices across the board, they're averaging somewhere between 1,000, 750, 1,000, 1,200 for compliance work based on a small business. That a practice today is worth somewhere between 80 pence and up to £1.20 for recurring turnover, because we've been involved in a lot of practice purchase and sales. A digital practice that's fully digital, that value of that practice for recurring income is 180, and it's pushing as fast as it can towards £2. So by just simply changing the way you work and changing the practice model, with proper advisory services, your fee of 1,000 can double and sometimes treble. So a treble will treble the value of your practice. We've seen this time in, time out. We use technology to make it easy to run the business. It's not the technology replacing the person. It's technology doing the work so that the person can talk properly to their clients and have the time and the budget to sit down with the client and have that conversation. The big reality in this is there's only 3 ways of growing any accountancy firm. There's no other way. There's only 3 simple ways of growing it. Get more clients, right? And the idea of piling clients into a system that's already full, that can't be got out, doesn't work long term. Because what happens is you overpromise and underdeliver the client expectation. The second thing is to increase your fees. Clients do not like increased fees for compliance work. But if you set this thing up properly, clients have no issues, in my experience, paying fees for work that they deem add value to the firm. And I myself did not get into the accountancy profession all those years ago to type up books and records into a system to produce a set of accounts without having the impact on having a conversation with the clients about what the effect those accounts have. The skill sets, all you have to do is look at the exam process in the IFA, look at the amazing things that are in there that you can actually learn and talk about. But many of us have actually used that. Many of us have used present value, or many of us have used that, the ability to understand how interest rates work. These are simple things that you learned years ago, but the real true value of that to a client is immense. The third way is to sell more often to existing clients. I know people are looking at that word sell, and accountants don't like the word sell, but I'll give you a simple example that we done recently. We were dealing with a practice recently, and the practice was looking to do a group structure in the UK, potentially, and imagine that group structure was worth, say, 2,000. By working and looking at and understanding properly, that fee was 4x'd, and no issues with the client signing it. So the idea of that and how you actually present the information to a client, because scope creep is a huge problem in the industry. We take on a job from a client, we've priced the job with the client, we sit and look at the job and we say, yeah, we're going to do that. But then we know that the bank account is not in, it's not written up, it's not reconciled. And we don't know how to actually approach the client properly to say, I'm sorry, here's where we are. We need to actually change this process, and we need to actually bill them accordingly for that. Digital advisory firms continue to add new clients to their business, and they also make more profit than anyone else by increasing the value of each client. The gold dust is in the firm, right? When I realized that we actually sat down, and this came from a real simple little story that I dealt with a client one time who was talking about leaving. And I was astounded because I thought, this client is not even dreaming about leaving me. I'm the best thing that ever happened to this client, until I realized that the client wasn't getting what they actually wanted from us, because I wasn't telling them what I could do. I kept it a secret. Imagine that, you keep the stuff that you're really good at a secret to the clients. Why is this different? Because now, as a digital advisor, compliance is the foot in the door to build a relationship, right? It's absolutely critical. You can build a proper, good relationship with a client through compliance because they feel protected. We assess exactly what the client needs to ensure they have fully protected their business and their lives. Nobody on this call, and there's 128 people on the call at the moment, not one person on this call can operate a practice without a license, because the institute won't allow it, and rightly so. So just imagine that example. You wouldn't get into your car and drive your car without car insurance. It just wouldn't happen, right? You get your own income protection, or you get your own protection in the business protection, right? But the simple thing is, we don't know how to protect our lives. We don't know how to protect our businesses properly. So we always look at that, right? We always look at how do we protect it. And it's not all about life insurance or income protection. It's about how do we structure the business for protection. The next thing is we understand that the real profit is made in offering complementary products and services to our clients. We call it building the back end. If you build the back end of the service offering, your fees will just increase exponentially. I was listening to a podcast the other day by Tim Ferriss, and it's the man who actually created Lululemon, right, which was a product that he sold, or were selling apparel online. And he said to him, there's 10 major decisions a person will make in their life. And that's all. And what are the major decisions? That's the first one he talked about was your life partner and your decision, that will have a massive effect on you going forward. So for me, that was obviously one, on having a family, and the other was going into business. That is a major life decision. But he said, when do you want to retire? And there's a lot of elderly practice owners probably on this call today, but there's a lot of them actually considering and wondering, how do I actually get out of here, and how do I make the value of my succession planning? But he made a great comment. He said actually that I was to retire at 42, and I'm actually 43 now and I'm retired. And he said, what does that mean, retirement? So the question was, what he was actually talking about was the ability to have the freedom as a practice owner to do what you want when you get up during the day. And that's possible. And you can get out of the day-to-day work. For me, that means I can go in the middle of the day and go for a walk or a run or a cycle or go meet my wife for lunch. It doesn't mean that I don't work, because I love what I do, but it means having that freedom of thought. So as a practice owner, is to get the practice owner away from the day-to-day where possible, and the freedom to spend time with the clients. So that's the strategy in education our clients. It's education, awareness, and accountability. We use technology to automate the traditional services. It doesn't eliminate them, but it automates them to allow us to spend more time on higher value work. This is a slide I wondered would I put in, would I put out? So I decided to put it in. If you can spot a problem in your client's business and can easily help them, but you choose not to do it because the fear of selling, you're actually doing yourself and the practice and the client a massive disservice. And the issue is, you know how to do this, but you might not have the technical tax knowledge. I don't. I can tell you that's why George is here. George is an absolute expert in tax areas. And somebody rang me yesterday to have a conversation about stamp duty. I said, to tell you the truth, I don't know anything about it, but I know the man who does. And it's the idea of having that ability and confidence with your client. They don't mind you not having known it, but having the ability to bring in a team of people around you that can actually offer these services to your client. You can compete with any of the largest firms in the country. I can categorically tell you that. I know you can, because I know the technical abilities that you have, but it's just about building that confidence in yourself to do it. As we said before, clients are more than happy to pay for service to protect themselves, their families, and their business. This creates the advisory relationship. I had trusted advisor here, an advisory relationship. Sometimes I like the word trusted advisor and sometimes I don't. But the question is, if the client picks me up, the phone up and asks me for a question, and I know the answer to that question or where to get, that to me is a true advisory relationship. The power of an accountant is the one person in a client's life is absolutely critical. And they really appreciate that and trust the accountant more than anybody else. So by earning that trust and helping them with the other things, we'll drive the business on, drive the institute on. The last thing I want to say is there's never, in my opinion, been a better time in the world to be an accountant in practice. The opportunities are endless. The number of clients out there are endless. You just have to understand what you're looking for and where you're wanting to go. We have the Accountants Club. You're more than happy to sign up. It's a very simple sign up. By signing up, there's a link in that sign up to have a conversation with me. If you want to talk to me about your practice or developing your practice, or you just want to have a word about something with another accountant, because it's a very lonely place out there for an accountant in practice. They don't know where to turn to. But I'd be more than happy to have a conversation with you. Sign up to the link. You will also get copies of these slides whenever you are with the IFA, and Linda's going to send them out. The incredible Linda. Incredible believing that there's 3 people here from a little town in Ireland, and Linda's one of them. And we all know each other. And we're all based in London. So it's a really small world when you look at all of this. So thank you so much for that. I know there's some questions in there and we'll get to them at a later point. I'm now going to hand you over to George. George is a lot more technical in terms of what he's doing, but it's an example of an opportunity. And just before I do that, there's a lot of your clients might not need this service. However, making them aware that it's possible shows the breadth of ability that the practice has to expand their service offerings. Thank you so much. And I'm now going to hand you over to George. Talk to you soon. Bye-bye.
Thanks very much, Paul. Hi, everybody. So nice to talk to you all today. I suppose the reason we're here today to talk about the possibility of using an Irish company is that since kind of Brexit has happened, we've seen a kind of massive increase in queries from people looking at potentially starting to operate from Ireland, looking at the benefits of using Ireland as a base to carry on their operations in the EU. We're seeing more and more of that, and I suppose we're dealing with more and more of that. We're dealing with more and more queries related to that, and we're picking up kind of practical points as we work through that may be helpful to you today. So I'm going to work my way through this presentation. We'll look at the benefits of using Ireland as a base. We'll look at what that involves in terms of setting up a subsidiary company or a branch or what might be involved. We'll have a quick look at the tax system in Ireland and how it operates. And if, as much as I can at all, as I work my way through it, I'll try and work it back to some kind of practical experiences that we've seen as we've helped UK individuals incorporate Irish companies, particularly in the last few months. Okay. So that's just the slide. The current slide there is just some of the benefits of trading in Ireland. I suppose the key thing at the moment is that since Brexit, Ireland is now the only English-speaking country in the EU. We still have a common travel area with the UK, And we also have the Northern Ireland Protocol, which means Northern Ireland can continue to trade with the Republic of Ireland without any real changes to what it had been before. As well as that, there was a number of reasons why firms had looked to operate in Ireland. So, I mean, it's very well publicised how popular Ireland had become, especially with a lot of multinationals and a lot of, for instance, Microsoft, Facebook, Google, all have their European operations headquartered here in Ireland. Some of the reasons for that are a 12.5% tax rate, which I suppose if it remains in place in 2023 will be half the corporation tax rate in the UK. English-speaking country, euro currency. So in terms of dealing with other countries in the EU, France, Germany, Spain, the big markets like that, we operate the same currency. I'll talk a little bit later about the holding company regime and how that works in Ireland. We've good withholding tax policies. We've reduced rate of corporation tax for R&D. I'll talk a little bit about that later. We have a cooperative labour relations system. We're politically stable, pro-business government policies at the moment, and a lot, I suppose, a lot of the landscape and a lot of our laws and everything else are very similar to the UK. Obviously, given our history, a lot of the legislation, a lot of like our common law basis for operation is shared. Okay, so they're the benefits as to why you might consider operating a company in Ireland. Like I said, the main ones: lower corporation tax rate and reduce the administrative burden that's been put in place as a result of Brexit, and to use Ireland as a base for maybe tapping into the rest of the EU market. Once you've sat down with your client and made the decision that it now makes sense for you to potentially operate from Ireland, the next question really is, should you establish a branch or a subsidiary? You'll both be aware of the difference, but essentially a branch is an extension of the foreign company and performs the same business operations, while a subsidiary is an independent legal entity that is either partially or wholly owned by the foreign company. I look through both options now. What I will say is that for the most part, what we're advising and what we're seeing people use is a separate Irish subsidiary company, as opposed to an Irish branch of a UK company. But look, there is no one size fits all. It'll depend on your client. It'll depend on the plans your client has. It'll differ from case to case. But for the most part, when we're looking at this, we've been advising people, a subsidiary seems to be the preferred approach. And that comes with its own issues, and we'll talk through that in a little bit more as well. So the key points in terms of incorporating a subsidiary in Ireland is that it will require an Irish registered office. The subsidiary will be a separate legal entity, separate from a UK sister company or UK parent company. It must have its own board of directors, okay? At least one of those directors must be resident in the EEA or the EU. Now that creates a slight issue, but we'll go into a little bit detail further how there's a workaround there if you've only got UK directors. The registered address in Ireland, and that can be provided. The subsidiary must maintain a number of statutory registers, including registered directors, secretaries, and shareholders. So a lot of this, like I said before, a lot of the law that operates in the UK will be very similar to the law that operates in Ireland in terms of what your requirements are for an Irish subsidiary company. So the subsidiary must prepare statutory financial statements. Again, very much in common with what you would do for your UK-based companies at the moment. A branch then is a little bit different, and like I said, not something we see as much of anymore, given the opportunities that there are with setting up a subsidiary. But a branch is not a separate legal entity, and while it can act independently, it acts on behalf of the other company. So really what it comes down to is with a branch, obviously there's no requirement to set up a new company, there's no requirement for new directors, or there's no requirement for EEA or EU directors, but it's not a separate legal entity and it cannot operate independently of the UK parent company. So, like I said, what we're seeing is mainly the use of a subsidiary or a separate legal Irish company, but a branch remains an option. And what I would say is, obviously, if you have any queries or if you have a client that's considering either, we would sit down, we would talk through, and we would decide what the best approach for them is. If that decision is to operate an Irish company, you have a few options as to how that can be structured. Now, most of the time, it'll be a private company limited by shares, okay? A DAC would typically be used if the Irish company has a very specific purpose, or if it's been incorporated as an Irish holding company, okay? A company limited by guarantee, very rarely going to be what you'll use in this instance. A public limited company, PLC, obviously, we've moved up a level there too, but for the most part, what you're going to be looking at is a private company limited by shares here in Ireland, and then decision has to be made whether that's a subsidiary of the current UK company or whether it just has common shareholders or whether a holding company is put in place in Ireland potentially. Okay, so I talked earlier about how we try and keep this as practical as we can be. So, I mean, there's a lot of information out there as to why you might decide to operate in Ireland. The practicalities of it is actually putting that structure in place. So, like I said, this is what we've seen since January as we've been incorporating more and more companies with UK directors to operate in Ireland. So we have to think about the company name, address, share capital, directors, officers, and residency requirements. Okay, so the company name, so the CRO may refuse to incorporate if the proposed company name is identical or too similar to a name already appearing on a register of companies, or if it is offensive or would suggest state sponsorship. So this seems very straightforward, but anytime that we speak to any of our clients, we always ask for 2 or 3 different company names, because even the most obscure names sometimes are already taken. And the rules are very strict in that there are certain words that don't distinguish a name from others. So I set up George Skelton Accountancy Limited. I'm then not allowed to set up George Skelton Tax Advisor Limited. The difference is there seem to be too close. So usually we'd work through that. We'll identify a company name that will pass the requirements of the CRO and address then. So really, like, again, it depends what's going to happen. Ideally, your Irish company will have a base in Ireland, will secure or lease a property here in Ireland that it will operate from, and that'll solve a lot of issues around the address. If not, there are possibilities where RDA or some of our partners could provide a registered office address for the company here in Ireland. Where this will come into play again is when we talk about registering for tax a little bit later. But again, I'd imagine the rules very similar to what you operate in the UK. In terms of share capital on an Irish limited company, there's no upper limit on authorised share capital, and the issued share capital typically for a limited company in Ireland is €100 issued share capital, but that really depends on the structure that you want to put in place. And like I said, you can set up a company with any amount of authorised share capital to give you flexibility moving forward. Okay, in terms of directors and officers, this is where things have really changed with Brexit. So up until January, 2 UK individuals who own their own UK-based company can come across, set up a company in Ireland, and as EU residents, there was no issue. That company could be incorporated with both of them as the company's directors. That's changed now since the 1st of January because the UK is no longer in the EU. So to set up a company in Ireland, you have to have an Irish resident or EU resident director, or you have to put a bond in place to circumvent that rule. Okay, so in terms of how that works, so you have an application to CRO to grant a certificate confirming the company has a real or continuous link with Ireland, or you provide a bond. Realistically, what tends to happen is you put a bond in place. Now the slide there says the bond is for €25,000. It actually costs about €2,500 to put the bond in place. There are people who offer that basically that insurance policy. They put the bond forward and you pay them around €2,500 to put that bond in place. What typically will happen is you will put the bond in place, and then after 2 or 3 years, you'll have built up business in Ireland, and at that stage you will have a real and continuous economic link with Ireland. And from that date on, the bond is no longer required. Okay, so obviously if from the start we can show if operations have moved to Ireland and there's a number of employees and there's an operating base and the directors themselves have even moved from the UK to Ireland, well then we potentially don't need the bond. We can potentially immediately show a real and continuous economic link with Ireland. But if that's not readily apparent at the start, we begin by putting the bond in place, and as we build operations in Ireland, that link will start to take care of itself And then once that the bond is usually put in place for 2 years. By the end of that 2-year period, we may no longer be required to continue to have the bond held on behalf of the company. But it is something to bear in mind if you're advising your clients to use an Irish company, that's been made a little bit more difficult now by the fact that the UK has left the EU, and that we will potentially have to put a bond in place if they don't have somebody they can use as an Irish resident director for the company, or an EU resident director for the company. Okay. So in terms, again, the requirements, so once you've set up the company, the actual filing requirements for that company, again, probably very, very similar to what you're dealing with in the UK. So an annual return, an AGM, financial statements have to be filed, corporation tax returns, and other relevant matters is the company must display its full name outside its registered office address, place of business, and on all company stationery. A bank account in the name of the company should be set up to facilitate any financial transactions, and we'll talk a little bit about setting up a bank account just later in the presentation. And changes to the particulars of the company capital director's office should be notified to the CRO within a specified time frame. Okay. So open up a bank account, again, in terms of the practicalities that we are finding. It sounds something that should be relatively straightforward, and it is, and it can be dealt with, but it's important, again, if you're advising your clients that the right decision is to operate in Ireland, we need to give ourselves time, because we need to get the company incorporated, we need to get the company registered for all the relevant taxes, and to get the company bank account set up. And sometimes that can take a little bit longer than you'd like, especially if there's no resident Irish director for the company. So it's just a matter, it's not an insurmountable task. It's absolutely fine. It's just a matter of giving yourself enough time to make sure that you have the bank account in place, you have the tax registration in place, you have the company incorporated before you want to begin trading here in Ireland. Incorporating a company in Ireland typically takes 2 to 3 weeks. Registering that company for taxes typically takes another week to 10 days. Where that time frame can be increased is if there's no Irish PPS number for either directors. So again, if you have a UK resident director, that director will have to apply for an Irish PPS number, which is effectively our social services number or a tax number. Okay, that takes another 2 to 3 weeks. So it's usually what we have is incorporate a company 2 weeks, apply for a PPS number for the director. Now that happens simultaneously with the company incorporation. That takes 3 to 4 weeks. And then register the company for taxes. That takes a week to 10 days. Immediately once the company is incorporated, you need to start thinking about the bank account so that can be put in place in parallel to the company being registered for taxes. But running the ship very, very well, you want to give yourself at least 6 to 8 weeks to get the Irish company operational and ready to go. Okay, so that's just the main points, and that's why we try to make this as straightforward as you can. You will need this information to set up a bank account in Ireland. So proof of ID, details of beneficial owners of the business, a completed bank mandate form, specimen signatures for all those who will authorise transactions, memo and arts of association, certificate of incorporation, certificate of business name, cash or cheques to lodge the new account, proofs of identification, and an opening deposit. So again, the process itself is fine. It's just a matter of giving yourself that little bit of time to have everything put up and in place. So, excuse me, we've now made a decision that we're going to operate an Irish from Ireland. We have decided whether it's a branch or subsidiary that's the most appropriate to our business. We have, if it's a limited company, incorporated that company. We have now looked at tax registering that company and setting up the bank account. Now just what we want to look at is a brief kind of overview of how the taxation system in Ireland works. And again, for the most part, it will not be very different to your own in the UK. Obviously, there will be slight differences here and there in terms of tax rates, in terms of different reliefs. But as a kind of overview or a kind of how it works or the feel behind the system itself, it'll be very, very, very similar. So in terms of corporation tax in Ireland, which of course any new company that's incorporated in Ireland will have to pay, the big benefit here is that corporation tax, like I said, is 12.5%. Now, the key point there is that corporation tax is 12.5% on trading activities, okay? On investment income or passive income, such as rent or deposit interest, it's 25%, okay? So that's, again, a key point depending on the client that you're advising. But any trading income is 12.5%. The corporation tax itself is due 9 months after the company's year end. So if a company's year end is 31st of December, you have to file and pay corporation tax by the 23rd of September the following year, okay? The 23rd is just the date of the month that all tax returns in Ireland tend to fall due on, okay? In Ireland as well, you have to pay what's called preliminary tax. And typically this is based on 100% of the previous year's liability. So again, if we start with a December year end company, if the previous year that company had a corporation tax liability of €10,000, it is required to pay preliminary tax of €10,000 on the 23rd of November, the month before the year ends, okay? If once you reach the following September and you file a tax return, it turns out the liability was 8,000 and not 10,000, the company's refunded the difference. If it turns out the liability is 15,000 instead of 10,000, you pay the difference and your preliminary tax is 15,000 the following November. The only exception to that is when a company's corporation tax liability is greater than 200,000. And in that case, preliminary tax is paid over two payments, one 6 months into the year. So for a December year end company, that would be June, and the balance paid in the November, the month before for the year end, okay? So just some tax reliefs that are there for corporation. I suppose a big one in Ireland is the R&D tax credit. So in Ireland, if the company undertakes activities that meet the qualifying criteria to be treated as research and development, the company gets a 25% tax credit for that, as well as a 12.5% tax deduction for the allowable costs. So that would include salaries of the people working in the R&D and any other direct costs related to the R&D. So effectively, if a company spends €100,000 on R&D in Ireland to qualify in R&D, it'll get a 12.5% corporation tax deduction on that expenditure as it runs through the P&L, and a further 25% deduction against the actual tax itself, a 25% tax credit, okay? The key point here as well is that if the company has losses, well, then the company can claim a refund of a third of that amount in each of the 3 years. So if a company has qualified R&D expenditure of 100,000, the 25% of that is €25,000. Excuse me. The company can claim 1/3 of that in year one, a third of that in year two, and a third of that in year three as a tax refund. Okay. The knowledge box, again, it's a more narrow application and may or may not apply to your clients. But if certain criteria is met, well, then an effective corporation tax rate is 6.25%. Now, what we're seeing in Ireland is this is a relatively new relief, but what we're seeing here is that the uptake hasn't been great. So the credit, again, it's very narrow, but dependent on your client and dependent on the activities is something that we would obviously consider to see if they apply for that as well. So there's also an exemption for new startup companies where there's no corporation tax, or the corporation tax payable for the first years does not exceed 40,000. Now, again, narrow criteria. We'd have to look at each client and each new trade independently to see if they qualify or not. But there is a possibility that would be there. And like I said, in terms of grants, there's a number of different payments. The main one being the R&D situation, where you can get a repayment of the actual tax credit as opposed to having to wait for when you have profits to set the credit against that. Okay. So as well as that, when you have, there's a dividend withholding tax in Ireland is 25%. So if you have an Irish subsidiary company and an Irish holding company, that Irish subsidiary company can pay dividend to the holding company without paying any tax. The tax is 0% between both companies. So that's another reason why, again, we'll talk a little bit about the holding company structure. Ireland is kind of seen as advantageous. Okay, so here we say an exemption from dividend withholding tax can be claimed by an Irish company in respect of dividend payments to certain types of shareholder. Irish tax resident, but also companies resident in the EU or DTA countries, which would include the UK, and individual resident in the EU or other tax resident companies. So what that essentially means is if I'm an Irish resident shareholder of an Irish company, if the company pays me 100,000 euros in dividends, they must deduct dividend withholding tax of 25% and pay that to revenue. And then I get a credit for that dividend withholding tax when I file my income tax return at the end of the year. But if the shareholder is resident in the UK, then provided all the conditions are met, there's no requirement for the company to withhold that 25%, and the full 100,000 euro in dividend can potentially be paid to the UK-based shareholder. Okay. So I mentioned briefly about the benefits of an Irish holding company, and in terms of the structure, one of the main reasons why people will use an Irish holding company is because if you have an Irish subsidiary company, dividends can be paid into that Irish holding company tax-free. All the other reasons are listed there in terms, like I said, English speaking and everything else. That's one of the main drivers behind why a lot of the big multinational companies have holding companies here in Ireland. Another key point is a capital gains tax exemption that's in place. So if an Irish holding company sells an Irish subsidiary and it's held the shares in that subsidiary for more than a year and holds more than 5% of that subsidiary, there's no capital gains tax payable here in Ireland on the disposal of that subsidiary. So that's a very, very kind of enticing arrangement if suitable to your current structure, or if you knew that you were building an Irish subsidiary company with a view to a potential future sale, that may make sense to include an Irish holding company within the structure. Okay. Just a very quick overview then before we wrap up. Once the Irish company is in place, any employees on that will be operated under the PAYE system here in Ireland. Again, very, very similar to what's operated in the UK. Basically, the company will register as an employer for PAYE, PRSI purposes, and any salary paid to any employee, the company will be required to deduct PAYE and PRSI from that payment and make payment over to revenue on a monthly basis here in Ireland. So we use what's called the PAYE modernisation system. It's all live. It's all very quickly operated. We could, if any of your clients need help on that, that's no problem at all. We operate payroll services. Very straightforward, just to be aware of it. There are some incentives. Ireland has a special assignment relief program which applies to employees assigned to work in Ireland. Subject to certain conditions, 30% of an employee's income in excess of 75,000 is exempt from Irish income tax, and an employer can cover the cost of flights, home, school fees on a tax-free basis. So again, what I would say is that you look at everything on a case-by-case basis. You see what structure you need in Ireland, you see what employees you might need to operate in Ireland, and then we consider what employee incentive schemes might be there to allow us to do that as efficiently as possible. And finally then, just have a quick look at the VAT system. So an overview of the VAT system is that typically bi-monthly VAT returns. So typically once a company is up and running and trading in Ireland, it will file bi-monthly VAT returns. The key point here really is that postponed accounting on imports from the UK. So while the UK was in the EU, everything between VAT registered traders between Ireland and the UK was mostly dealt with on a reverse charge basis. And the fear was that the VAT system might change considerably once the UK left. But basically what they've allowed for now is postponed accounting on imports from the UK, which effectively operates in the same way that the reverse charge basis did. So postponed accounting arrangements enable VAT registered traders to self-account for VAT on imports on their VAT return, so that import VAT may, subject to the usual rules of deductibility, be reclaimed at the same time excuse me, as it is declared on a VAT return. So it basically means that the admin burden or the cash flow cost doesn't change to what it had been while the UK was still in the EU. What I will say about the VAT system here in Ireland is that we spoke briefly earlier about registering the company for taxes in Ireland. And if you advise your client to set up a company in Ireland and we begin that process, registering for corporation tax in Ireland is a formality. Registering for PAYE in Ireland is a formality. Registering for VAT can be a little bit more complicated. And the revenue here in Ireland will typically look for more information as to what your planned operation in Ireland is, how you plan to trade, where you plan to trade from, the number of employees, because they want to be satisfied that there is going to be a valuable activity undertaken in Ireland before they provide that new company with an Irish VAT registration. So all these factors, all these things have to be looked into in detail as we build through this system. We had a case recently where initially the client was rejected for a VAT registration number here in Ireland. But we went back and we showed, what we did is we showed that the client actually had a list of orders that were going to be taken in Ireland. The client wrote a detailed letter of what their operations were going to be in Ireland, how they're going to operate, the fact that they were looking for a larger property to operate from, the fact that they had advertised for a manager to operate that side of the operations. So when we put all that together, then Revenue accepted, you know, they had incorrectly refused the VAT registration and they registered that company for VAT. So it's just important that you cross all your T's, dot all your I's, get everything in a row and ready to go, so that the VAT registration process can move as fast as we need it to, as we work through. The mini one-stop shop, just to touch on it very briefly, because whether it applies to you or not depends on the client, is just a simplification measure really in terms of reducing administrative burden if you're the business for the supply of telecommunications, broadcasting or electronic services to non-taxable persons. What's also going to happen is from the 1st of July, the EU is going to operate, so that if you have an Irish VAT registration, you won't also need a German VAT registration if you operate in Germany. You won't also need a French registration if you operate in France. So having that Irish VAT registration will become very valuable in that sense, as dependent on what your plans are for trading in the EU. Okay, so that kind of wraps up the presentation. Like I said, the main point that I would say is that each case needs to be looked at individually, but there are obviously clear advantages to operating or using an Irish company, or adding an Irish company to the current UK structure you have in place, in terms of the lower CT rate, in terms of the ease at which Irish companies can operate with other companies within the EU once the search it's set up. For instance, what we're going to see a lot of now is a UK company will supply the Irish company, and the Irish company will then sell to the different markets within the EU, so that the administration is only between the UK and the Irish company and not between customers in France, Germany, Italy, Spain, or wherever that may be. Okay. Well, thanks very much. Our contact details are listed on that last slide should you need to contact us or talk through any of those points with us. Okay, thank you.
George, thank you. Paul, thank you as well. George, I'm going to dive straight in because I've got 2 or 3 questions to ask for you.
Okay.
Does a company director have to be Irish before he or she can open a company in Ireland?
The answer to that is, at the moment, the company needs either an Irish resident or EU resident director, unless you put in place a bond or you can show a clear and real continuous economic link with Ireland. So effectively, like I said, what we're seeing happening is if you have 2 UK-based directors who also want to be the director of the Irish company and they have no relationship with an Irish director or a EU resident director, is we put the bond in place. It costs about €2,500. Yep. That bond stays in place for 2 years, and in the meantime, you've built up your continuous link. The company's operating, trading in Ireland, and at that stage, the bond will no longer be required.
Slide 14, Jonathan, it's slide 14 on George's files is answered on it.
Right, lovely. No, that's great. Thank you, George. Thank you both. Another question or an observation. I looked at forming an Irish company for a UK corporate micro entity client to operate drop shipping in the EU generally, but they were put off by the requirement to have Irish customers / suppliers. Any advice?
I'd say you'd want to look at that as a separate question. Maybe if they reach out to George with the question, we can have a conversation about a little bit more about what the type of business is. There's no, if they want to just give us a chat, we'll probably look at that separate.
But I suppose as a general rule, you have to have some level of operation in Ireland in terms of, they don't necessarily have to be Irish customers, but there needs to be a level of activity. in Ireland. As a
Okay.
kind of now, like Paul said, the best thing to do is it's a very specific question, so we need a lot more specific details before we can get into an in-depth answer. But usually what you need to see is that if you set this up as a kind of shell, it'll be very hard to meet some of the revenues requirements for VAT registration. You need to show a level of activity. Like there has to be a desire to actually operate from Ireland for this to make sense for you or your client.
Okay, no, I understood. I think you will find that if we are able to share your slides, George, with the participants today, I know on your final slide you included contact details, but I think probably you'll find that a number of attendees will ask further questions, having probably reviewed the slides or read through them in more detail. So if your contact details are there, great. I've also been asked on a couple of occasions through the questions and the chat box, will the slides be made available? I hope I'm not making an assumption.
No,
but,
they're more than welcome to both sets of slides for if they have, and they're more than welcome to sign up to either the Accountants Club, that address that we put earlier on, and they can access the slides through there, or they can come, I think Linda's going to send out, George will send a copy of the slides, both sets of slides, and they'll be sent out to all participants. It never cost me any money sharing information. So more than welcome. Information is about growing.
If you need to contact us, rda.ie is the website address, and all our contact information is
there as well.
Yeah.
No, that's great, gents. We will share your slides and contact details tomorrow. I take your point that specific questions might need a brief conversation with more detail being provided. Paul, I did have a question that related back to what you were talking about. You referenced an app that your firm or you are using in general, and the question was, what's the app that you're using?
Well, the question is, it depends on the particular situation that practice. I'm not avoiding the question, but I'd really want to reach out to the practice want to reach out to me, because the app depends on the stack and it depends on the type of practice they are, because XPM is one of the main apps we use, but depending on what software the practice uses, there's an option of a couple of different apps, but the one we particularly use is Xero Practice Manager. It's probably giving a hint that we're actually a Xero Practice of the Year, but we're very, very happy to go through and have a conversation with that. But that particular app, wrapped up with a couple of other apps, I mean, it puts the practice on autopilot and on steroids. It's a really, really powerful piece of software if used properly. A lot of people don't like it, but it's an incredibly good piece of software.
Okay, right, thank you. I'm coming back, George, to you. An attendee asks, I have dual British/Irish citizenship, but am resident in the UK. I assume that because I'm not a resident in Ireland, I would need to pay a bond.
Yeah, that's correct. It's based on EU or Irish residency as opposed to citizenship.
A great question.
What I would do is it'd probably make life easier in terms of setting up bank accounts and some of the other practicalities, having an Irish passport, but the bond may still need to be put in place.
Okay, thank you. And then a question, if a holiday home business, corporation tax at 25% then?
That I would say 12.5% if it's a business. If it's operated as a business, like no different than a hotel, if there's a number of holiday homes and that's a trading entity, it's 12.5%. If it's a long-term let, if it's rental income, it's 25%. So it really depends on the level of holiday homes. If it's one holiday home that's let long-term, that's rental income. If it's a number of holiday homes and there's a level of administration and actual business.
And the closed company surcharge, George.
Yes, another, just Paul mentioned there that in Ireland, rental or passive income is 25%. But if you don't then distribute that income within 18 months, there's a further surcharge called a closed company surcharge, which effectively brings the tax rate up to 40%. It's another 15% on top, but only if you don't pay a dividend within 18 months. But the question there really is the holiday home business a trading activity or an investment activity? And if it's a trading activity, and there might be scope to argue that, then it's 12.5%. If it's one holiday home on a long-term net, it's rental income and it's 25% plus the closed company surcharge if income isn't distributed within 18 months.
Thank you for that. I do note that a couple of people have raised their hands. I can't act on people raising hands, so if you're raising your hand to ask a question, please do use the chat or the Q&A facility. If there aren't any other questions, I'm conscious of time for everybody. To recap, we will share a recording with everybody within 24 hours. We will provide a copy of Paul and George's slides with their contact details. I would strongly suggest, if you have specific questions or scenarios, both George and Paul have kindly said, please make contact with them for, maybe a further chat or clarification. I would strongly suggest that's taken up. Sorry, I do see a further question, George. So does the close company surcharge apply to trading companies as well as an investment company?
I suppose the non-complicated answer is no, but the complicated answer is maybe, depending on, it applies to service companies. So an accountancy company, for instance, an accountancy practice that operates through a company, there is another closed company surcharge that relates to professional services. So the closed company surcharge relating to rental income only relates to passive income, will never impact the trade. But if there is a service trade, so engineer, architect, accountant, there is what's called the professional services closed company surcharge. It's calculated slightly differently, and it brings your effective tax rate to 19% instead of 12.5% if it applies to you. Again, how it works is you pay 12.5% tax, and then if you don't distribute your profits within 18 months by way of a dividend, a further effective rate of 7.5% applies to what remains. But it only applies to service companies. And there's a kind of limited scope as to who it applies to. For the most part, for 90% of companies, it won't impact them at all. But like I said, accountants, architects, engineers, those type of professions, it needs to be looked at.
Reach out and ask the question. If you have a company in Ireland, that's the way to answer that.
Look, I think, Paul, you've just summarised what I was going to say. I think if anybody has any queries, any concerns, or they want clarification, do reach out to George and Paul. It sounds like the gents would be only too happy to help.
Yeah, and just see us as your partners in the practice. Like you have ability to do anything you want in Ireland. There's a lot of technical stuff here, but it's a very welcoming place to do business. And there's nothing in there that we can't help you organise. So there's nothing to be afraid of from a practice owner with someone wanting to go to Ireland. Absolutely nothing to be afraid of.
Thank you. I'm conscious of time, so I'm going to bring us to an end.
Thank you.
Paul, George, can I thank you from and on behalf of the Institute for your time and your contributions this afternoon. The subject matter for today's National Branch meeting was actually sort of suggested at the request of a member. So I'm glad that I've listened to that, we've listened to that, and through Paul and George, we've been able to provide you with what I hope has been a very useful and informative webinar. George, Paul, thank you very much.
Thank you.
Thank you for attending. We look forward to seeing you at the next National Branch meeting. In the meantime, stay safe, keep well, and have a good afternoon. Thank you, everybody.
Bye-bye, everybody. Thank you.
Bye-bye.